You've seen the headlines about a $50 billion Super League designed to save college football. But here's the truth, that valuation is a fabrication. It is a number engineered by private equity firms to strip mine university assets, not save them. We are debunking this figure using 4 specific financial indicators: media rights fragmentation, private equity hurdle rates, antitrust barriers, and hidden liability costs. This isn't just a sports story, it is an investigation into a corporate takeover. Let me show you why the math doesn't work. The pitch for the Super League sounds incredible on paper. The proposal suggests that by consolidating the top 72 permanent teams into a single entity, the league can generate $5 to $7 billion in annual revenue. The architects claim this creates an NFL-style product that maximizes value and stabilizes the chaotic transfer portal. But when you run the actual media rights math, you see that this market is already saturated. Network partners like ESPN and Fox have finite budgets. They have already committed the bulk of their capital to existing Big Ten and SEC deals through the early 2030s. There is no secret vault of cash waiting to be opened. When you strip away the hype, the realistic revenue cap for a consolidated league sits closer to $2 or $3 billion. That is a massive shortfall from the projections being sold to desperate athletic directors. Actually, let me back up and explain the House settlement data point, because this is where the profit margins really crash. The recent legal settlement mandates $2.8 billion in back pay to athletes and establishes a revenue-sharing cap of roughly $20.5 million per school annually starting in 2025. The thing most people miss is how this impacts the valuation multiple. If you look at the proprietary model on screen, that settlement forces an immediate revenue redirection of 22% straight to the labor force. You cannot sustain a $50 billion valuation when nearly a quarter of your gross revenue is legally siphoned off before you pay a single coach, fund a scholarship, or service any debt. Now you might be thinking, can't they just bundle the rights like the NFL to make up the difference? The answer is no, and here is why. The NFL enjoys a specific antitrust exemption under the Sports Broadcasting Act of 1961. This allows them to sell rights collectively without violating the Sherman Act. College football does not have this protection. This fragmentation problem means that if these 72 schools attempt to bundle their rights, they trigger immediate antitrust lawsuits from the schools left behind. The collective value is a myth because the legal structure required to unlock it doesn't exist. Without that exemption, the Super League is just a loose confederation of schools inviting federal litigation. So we have a revenue ceiling that is billions lower than advertised, and a cost structure that is about to explode due to legal settlements. The math is broken, but if the numbers don't work for the schools, why is the deal moving forward? The answer lies in the specific type of investor pushing this restructure. Now here is where most people mess up their analysis of this situation. They assume private equity firms are stepping in because they love football or want to save the traditions of Saturday afternoons. That is naive. Private equity exists for one reason: to generate returns that outperform the public market. And this brings us to the PE playbook and a fundamental financial conflict known as the hurdle rate. You need to understand the math behind the money. Top-tier private equity firms typically target an internal rate of return, or IRR, of 20 to 25%. They need to double or triple their investment within a 5 to 7 year window. Compare that to the business model of a university athletic department. Even the most successful programs, like Alabama or Michigan, operate on razor-thin margins. When you strip out the donations and subsidies, their actual operating margins, effectively their EBITDA, hover between 5 and 10%. Do you see the problem? You cannot service a partner demanding a 25% return when your underlying business only generates a 5% margin. The math forces a collision. To bridge that gap, the private equity firm doesn't just take a share of the profit, they take a share of the revenue. They strip mine the top-line income before the school pays for expenses. This isn't a partnership. It is a predatory loan disguised as an investment. We have seen this exact scenario play out in Europe, and it provides a terrifying roadmap for US colleges. Look at the deal between CVC Capital Partners and La Liga, the top Spanish soccer league. In 2021, CVC injected 2.7 billion euros into the league, In exchange, they took roughly 8 to 10% of the league's media rights revenue for the next 50 years. Think about that timeline. A 50-year mortgage on your primary income source. The biggest clubs, Real Madrid and Barcelona, immediately rejected the deal. They understood that trading a quick cash infusion today for half a century of diluted revenue was financial suicide. They sued to stop it because they knew that inflation and media rights growth would eventually make that 2.7 billion euros look like pocket change, while CVC would keep collecting their 10% tax for decades. This almost happened in the United States recently. The Big Ten Conference entertained a proposal from UC Investments to provide a $2.4 billion cash infusion. The pitch was seductive. Give every school a quick $133 million check to handle their debts and facility upgrades. In exchange, the investors wanted a percentage of the future media rights. But when the university presidents looked at the cap table, the ownership structure of the deal, they balked. The structure works like a waterfall. If you visualize the flow of money, the private equity investors sit at the very top of the waterfall. When the TV networks send the check, the investors take their cut first. The schools get whatever trickles down to the bottom. In a nonprofit university model, this loss of control is catastrophic. If a school faces a budget crisis, they cannot renegotiate the terms with a private equity firm the way they might with a donor or a state legislature. The firm has a fiduciary duty to its own investors to extract maximum value, even if it means the university has to cut the English department or fire the coaching staff to make the payment. This structure works in European soccer because those clubs are for-profit businesses that can issue shares or be sold. US universities cannot be sold. They can only be bled dry. This financial restructuring creates a binary world, the survivors and the kill list. We don't have to guess what this looks like because we have a real-time case study happening right now. The gap between Ohio State and Washington State perfectly illustrates the future of the Super League. Ohio State is the winner in this model. They are an athletic corporation masquerading as a university. In 2025, their projected football revenue will hit $160.5 million. They will receive a conference payout from the Big Ten exceeding $75 million. This liquidity allows them to aggressively fund their NIL collectives, buying the best roster money can buy, while simultaneously upgrading their facilities to professional standards. They can absorb the revenue-sharing requirements of the House settlement and still turn a profit. Now look at the other side of the ledger. Washington State. Following the collapse of the Pac-12, they are the ghost of college football future. Their media revenue has evaporated. They are projecting total athletics revenue of just $30 to $40 million, a fraction of what Ohio State spends just on coaching salaries and support staff. The consequences are immediate and brutal. Washington State is facing an annual deficit of $10 to $15 million. They aren't just cutting corners, they are facing an existential crisis. This creates a death spiral. With less money, they cannot recruit. Without recruits, they lose games. When they lose games, the remaining TV value plummets further. We are already seeing the knock-on effects: hiring freezes, staff reductions, and the looming threat of cutting non-revenue sports like swimming, track, and baseball. But here is the twist that the Super League architects ignore: the antitrust wall. The NFL can get away with a closed system because they have a specific exemption from the Sherman Antitrust Act. They are allowed to collectively bargain and bundle their rights. The NCAA does not have this protection. If the top 72 schools try to break away and form a Super League, excluding the likes of Washington State or Oregon State, they will face an immediate barrage of federal lawsuits. The excluded schools will sue for group boycott and restraint of trade violations. Without a congressional exemption, which is highly unlikely given the current political climate, the Super League would be tied up in court for a decade. You cannot build a $50 billion business when your legal foundation is made of sand. Furthermore, the glossy brochures for the Super League conveniently leave out the hidden liability costs. We mentioned the House settlement, but that is just the beginning. The move toward a professionalized model accelerates the push for athlete unionization. If college football players are deemed employees, which the National Labor Relations Board is actively pursuing, the cost structure explodes. You are looking at mandatory workers' compensation, payroll taxes, and collective bargaining agreements. Additionally, Title IX compliance becomes a financial nightmare. If you pay the football team purely as employees, You likely trigger a requirement to provide equitable funding for female athletes, potentially adding another $10 to $15 million in operational costs per school annually. These are not rounding errors. These are massive fixed costs that destroy the projected profit margins. The Super League model relies on the idea that they can keep all the revenue while shedding the traditional obligations of the university model. But the law says otherwise. The final casualty in this financial war is the Olympic development pipeline. The reason the United States dominates the Olympic medal count is that our universities effectively subsidize the training of world-class athletes in swimming, track, and gymnastics using football revenue. When private equity takes their 20% cut and the settlement takes its 22% share, the money for those non-revenue sports vanishes. The Super League isn't just a threat to the tradition of bowl games, it is a direct liquidation of the infrastructure that supports nearly every other sport in the country. The Super League isn't a growth strategy, it is a liquidation event for private equity to extract value before the bubble bursts. The $50 billion valuation is impossible once you factor in the House settlement, antitrust laws, and profit margins. If you want to know what happens next, ignore the rumors and watch for legal filings regarding grant of rights extensions. That is the true signal of change. Subscribe for more financial deep dives.